Hi, welcome. In this video, we'll be talking specifically about financial disclosures. We'll start off with at the end of each fiscal year, companies with public securities, which means companies that are exchanged on the stock exchange, are required to file an annual report. So annual report contains many things, and that annual report is actually called a 10K. That's the one reported at the end of their fiscal year, and includes the financial statements such as the balance sheet, income statement, and also some additional disclosures are required. And it relates to many, many things. These are just a list of some of the very few things that are required that are reported in the annual report, such as their stock performance, management's discussion analysis. They might have related party transactions, all sorts of things. So let's talk specifically about the disclosure notes. So why do we have disclosure notes? It's because on the face of the financial statements, just looking at the numbers doesn't give us the complete information the investor or a user of the financial statement needs to make a decision one way or another. So we supplement the financial statements themselves with disclosure notes. These are just some examples of the disclosure notes. These are required. Composition of inventory. If you have inventory, you have to break it out between your raw materials, work in process, and your finished goods. And so let's talk about PP&E real quick. One of the disclosures that's required is you have to disclose it based on the major types of PP&E that you have, such as land, building, equipment. You have to disclose the cost for each of those categories, as well as accumulated depreciation, as well as your total depreciation expense for the year. Another disclosure is the maturity dates of your long-term debts. You could have, you have to disclose related to income tax expense, your current income tax expense versus your deferred income tax expense, and so on and so forth. There's just a lot of information that is required that's in the disclosure notes. There's also specific disclosure notes. This will be the first one that you see after the financial statements, and that's called the Summary of Significant Accounting Policies. And just like it says, it conveys valuable information about a company's choices among their various alternative accounting methods. It's really anything the management and the auditors eventually feel that the user of the financial statements needs to know to make a decision about the company. Another specific disclosure statements are subsequent events. These are events that occur after a company's fiscal year end, but before their financial statements are issued. So what does that mean? Assuming you have a 12/31 year end, if an event happens, let's just say 12/31/25, if an event happens between 1/1/2026 and the time you issue your financial statements, your 10K, let's call it 3/31, that's pretty late, but we'll just say anything that happens in this time period right here are subsequent events. So, and they could be examples of some of the subsequent events is you could sell some of your assets that were on your books at the 12/31 date and sold for either a significant gain or loss, or just if it's important for the reader to know that these specific assets were sold. It has to have some sort of significant importance. It's not just sale of any asset. If your company went through a business combination or sold the company sometime between January 1st and March 31st. And these dates are just examples. Many public companies, they file with a 12/31 year end, file their 10K well before March 31st. But if anything happened after the fiscal year end and before the filing date, they have to disclose it. If they issued debt or equity securities, and these would have to be really material. It would have to be something that would affect the user's decision making had they known about it at 12/31, had it been reported on the 12/31/25 financial statements. There are also noteworthy events and transactions that also need to be reported. And these events don't necessarily occur in every company, and some of these events hopefully don't occur for the company. The most popular, or the most common, I should say, noteworthy event are related party transactions. Related party transactions need to be reported because they're transactions between owners of the company and parties that could have significant influence over the decision of the board of the directors or the owners of the company. So to think of a family member of an owner or the management is really the easiest way to think about this, that could really influence, the family member could influence the owner or management of a company. And some of the related party transactions that you might see are that the company got borrowing or lending rates below market rate. So they're able to borrow money well below what the market rate is. That's a related party transaction if it's between two parties that are related with, they're not blood related necessarily. There's a specific definition for related party transactions. So those need to be disclosed. So this is the most common. Other ones that might need to be disclosed are errors and fraud. Errors are unintentional errors. They're mistakes. They are unintentional. Fraud are intentional misstatements of the financial statements. And these have to be material. They have to be a material amount. They have to make a difference. They have to impact the decision making of the user of the financial statements. So even if it's unintentional, it still needs to be disclosed as a note to the financial statements. And then also, if the company has found out that there's some illegal acts going on by some of their employees, then those need to be disclosed as well. Another part of the annual reports is called the management discussion and analysis. And the MD, and it's also referred to as the MD and A. And this is really a discussion by management. So this should be written by the management about certain events and trends and uncertainties related to the operations, their liquidity, their capital resources, and other items. So it's just to let the reader know more information. There is management's responsibility. The management is responsible for preparing. They're responsible for preparing the financial statements. And really, the top managements are not really the ones who are preparing it, but they have to certify that the information that's contained in the annual report are conforming, the information contained in the annual report, as well the assessment of the company's internal control procedures, are in line with what's required under GAAP. So basically, it's that they're asserting that all their financial statements are conforming to generally accepted accounting principles. And they also, this certification is required per the Sarbanes-Oxley Act of 2002. Here's just a quick example of an MD&A note in PepsiCo for undisclosed year, but it just kind of lists out different various pieces of information that the management feels the reader should know about. Another disclosure that is required on the annual, actually this is not on the annual report, it's a separate report called a proxy report, but they must be provided each year to all the shareholders it's along with the annual report. It's filed separately and it's along with the annual report as well. It's included in the annual report. But it's a statement that includes, it's a statement that invites all the shareholders to the annual meeting to elect board members and vote on issues. And it also includes the compensation and stock option information for the directors and top executives. This is so that companies can be transparent as to what they're paying their top executives, and their compensation is not just their salary, their dollars, it's the stock options, which is often makes up a significant portion of their whole compensation package. Another disclosure is environmental, social, and governance disclosures, also called ESG. And the environmental disclosures focus on environmental impacts, and the most common is the greenhouse gas emission. Social disclosures include issues of interest to social justice issues, I should say. So, like the CEO pay ratio. How does your CEO get paid relative to other CEOs? How do men versus women get paid relative to each other, right? To make sure that we can see, does one gender get paid more than the other? And also, these are just examples of gender diversity ratio. There's also governance disclosures, which include the company's actions and policies related to the division of power within the company. So they have disclosure about their independence of the board of the directors who oversee the company. So the CEO of a company essentially reports to the board of directors. So there's oversight there. Governance will also talk about any ethical policies and gender diversity that they have. So a 10K is issued only after it has to be audited, and the company prepares their financial statements and their disclosures and everything that's required on the annual report. And then the auditors come in, and when we say auditors, there's 4 big audit accounting firms globally, and they do a lot of the audit work for the really large company, really, really big companies. Think of all the companies that you know and have heard of: McDonald's and The Gap and Apple and Meta, etc. And those big 4 companies are Deloitte, EY, PwC, and KPMG. But what they do is they examine the financial statements, and they have to attest to the fairness of the financial statements. So basically they say, do we agree that these financial statements are correct, or are they not correct? And there's 4 types of auditors report that auditors can issue. And we'll go through them in the next few slides. So one is called the unqualified auditor's report. And an unqualified auditor's report means clean. It sounds counterintuitive because it sounds like they don't qualify the numbers, but it's actually the opposite. It's an unqualified report is what you want. An unqualified opinion is what a company would want. It means the auditor has looked at the financial statements and that they said they are presented in conformity with GAAP. And these are just some of the items that the auditors would go through to issue such a report. Sometimes the financial statements are conforming with GAAP. However, the auditors feel that there's some other information that needs to be emphasized to the financial statement users. And these can include lack of consistency. If there's a going concern issue, right? If the auditors feel that this company, yes, their financial statements are in conformity with GAAP, but guess what? We think that there might be a chance that they won't be around much longer. Or if there's a material misstatement in one area of the financials, but the rest of them are presented correctly, that could be an unqualified with an explanatory paragraph. Then there's these other audit reports that the auditors can issue, and these are really, they're called qualified opinion, which I already put an X right here, or adverse opinion. And qualified opinion versus an adverse opinion, there's really a fine line between the two, but companies don't want either one. And those happen when the auditors determine that the financial statements are not reported in conformity with GAAP. They're not following proper accounting principles, or there's just inadequate disclosures. They don't have enough information for the reader to make a useful decision. Or maybe if there's a really huge limitation on the scope of the audit examination, like maybe management will not let them see reports, or they just don't have the information that they need to provide the auditors to give them comfort with the numbers on the financial statement. Depending on the severity of these issues, they can issue a qualified opinion. And if the issues are really severe, it's really, really limiting, and you really cannot rely on any of the numbers in the financial statements, they will issue an adverse opinion.